you want to show people the recession probability forecast that comes out of Bloomberg data? Let's just take a look at the slide. It shows quarter by quarter set of essentially forecasts aggregated by Bloomberg. And what it shows is that before the COVID recession, the forecast had gradually crept up to 40% risk of recession. And then the COVID related recession occurred. And then, of course, it settled back down. And now we see it creeping back up. The most recent data we have out of Bloomberg is 25% odds of recession in the forecasts. Doesn't mean it's going to be right, but at least the trend is that the risk of recession is going up. And so you touched on dividends. So we're going to just show you some interesting return data on historic market performance during recessions of equities, of dividend growers compared to value. And actually, it's the other chart produced historical market performance during recessions. There we go. So this just shows, the recent couple of recessions and just compares performance of value stocks to dividend growth stocks. And basically, the dividend growers outperform value substantially. That's the main message for people to think about. So you touched on dividend growers. This confirms what you were talking about, that the dividend growers really do outperform. And these last two recessions show that the outperformance is something like 12%, pretty meaningful. We then take a look at the other slide the producer just had up a second ago and just see how the dividend growers have performed during inflationary periods. People are thinking of recession, they're thinking of inflation. Let's look at inflation here. The dividend growers, this is really surprising. In the really low inflation environment, they didn't have their best performance. Nothing had their best performance in these recent years of low inflation. Of course, the reason is there are other things going on in the markets other than just inflation. Back in those years as well as today. And so you see actually what's really useful from this, the dividend growers outperform dividend cutters, outperform those that had a no change in their dividend patterns. And that's pretty much universally the case, whether inflation is low, moderate, or high, the dividend growers do well relative to the rest of the stocks in the market, and they actually do so with less risk. So that's our wrap up in a way for people on how to think about inflation, recession, stocks, bonds. Where do I put some money? We're obviously fans of dividends. OUSA, OUSM are quality dividend strategies for people. OUSA is large cap, OUSM small, mid cap, trending towards mid cap, where the stocks are selected because they have good profitability, good dividend growth, etc.
Yeah. If I may add, I was just going to say, what I think is also crucial here is just that distinction between your high dividend payers versus your dividend growers. So we've seen a lot of money, for example, this year go into your high dividend payers because the people are looking for income specifically. So they want that, high yield figure. But in truth, the growers is really a quality story. It's companies that have been able to steadily, some of these dividend growers ETFs, the screens are like at least 25 years of consecutive, consistent growth in dividend payments. These are really, really big quality names. So it's a different story than a company that may be shelling out a huge dividend yield right now, but actually big cuts in the near future, to your point. So I think it's an important distinction to make.
It really is. And the high dividend payers have more sick companies in them. The dividends sometimes are high because the company is not doing so well. Its stock is low and they haven't cut the dividend yet, so the yield looks good. Also, a lot of them are in the commodity space and people are chasing commodities. The dividends are high. And I think commodities can at times be a wonderful trade. But if you look at the history of commodities, it's a very challenging investment space because commodities whip around up and down. And the dividend growers, the other thing about income is this: people worry more about income today or what their income is going to be like when they need it at retirement. And so income growth is something really important to think about as an investor or for clients, for advisors, than income today. And if you have clients that have a portfolio that they're going to rely on in 5, 10, 15 years, the dividend growers might get them to a much better place at the time they need the money than buying high yield stock or portfolio today that's at risk of either not growing or just declining. So it's really important. I think is the income strategy one to build income for the immediate future, next week, next month, next 12 months, or is it for the 5, 10, 15 plus year future?
Yeah. Time horizon is everything for sure. In the high dividend yield ones, if you just look at the sectors, if you want to get a sense of what you're getting, and your high dividend payers are all in like companies like Valero Oil, which is up 50% this year, and it's giving up almost 4% in yield. But it's a lot of energy names in there. So is that where you want to be? If you look just at the history of the last 15 years, has energy been the sector to invest in? So it's very different than the dividend growers, where it's more health, it's financials, it's very different sector exposures there. So
yeah, I spent a lot of my early career doing mergers and acquisitions, investment banking for oil and gas, energy stocks, natural resource space, and it's an incredibly volatile space. You live through it for years and years and years. You realize how almost randomly volatile it can be. War breaks out, oil spikes. Peace breaks out, supply grows, oil tanks. I mean, we've seen it go from 0 to 100 more than once.
To negative 40. Yeah. We've seen it all.
Exactly. But it can be a wonderful trade. Maybe it's a bit late to be making that wonderful trade today at oil where it is today. But who knows? Who knows?